Good day to you all. I'm Howard Landsberg, real estate tax practice leader at Mazars in the United States. Mazars is a leading international tax, audit, and advisory firm. We operate as one integrated team, leveraging our expertise, scale, and cultural understanding to deliver exceptional and tailored services around the globe. Specifically, the Mazars Real Estate Practice has offered solutions and top-level advice to real estate investors, owners, managers, and developers. We have special insight in today's volatile real estate markets and guide clients to long-term success and maximum profitability. We serve as advisors to the full spectrum of real estate companies, including prominent real estate funds, institutional investors, and real estate owners and real estate investment advisors. With that being said, I'd like to welcome you to the first installment of the Mazars webinar series on real estate private equity, emerging real estate funds. Throughout this webinar series, you will learn more about the Mazars Real Estate Practice, our experts, and key issues in the private equity space. We will be discussing investment strategies, whether to vertically integrate or not, the difference between open and closed-ended funds, and other topics. Today's webinar, Emerging Funds, will be led by John Comfrey, a partner at Mazars, and David Heyman, managing partner of Meltzer Lippi. And here's David to tell you a little bit about himself.
Thank you, Howard. And I want to thank you and John for inviting me to participate in today's webinar. As Howard mentioned, I am the managing partner at Meltzer Lippi. We are a full-service law firm with offices in Mineola, New York City, and Boca Raton, Florida. Our practice areas consist of corporate, real estate, environmental, bankruptcy, labor and employment, commercial litigation, tax, trust and estates, estate litigation, and elder law. My main practice area is assisting clients in the formation of real estate joint ventures and funds, an area in which I have been representing clients for over 30 years. Over that time, I have drafted hundreds of fund documents, many of which involve complex capital structures, management rights, exit strategies, and other variables. In addition, I represent clients in M&A transactions, structured finance transactions, securities compliance matters, UCC foreclosures, and general contract review. For many of our clients, I will function as the client's general counsel, and together with the other members of my firm, will provide general legal advice to the client across multiple disciplines. And now it's my co-panelist, John.
Thanks, David. As Howard mentioned, I'm a partner here at Mazars. I work in our audit and I lead up our advisory practice in our real estate group. Within real estate, I specialize in private equity. So my clients range in fund size from 5 million all the way up to 2 billion and everywhere in between. So we've seen a lot of different things, and we're happy and excited to have everyone join today, and we'll be able to share some knowledge and some tips and tricks along the way. And with that, I'll pass it back to Howard.
Thank you, David and John. As previously mentioned, we're going to discuss today investment theses and strategies, target fund size and capital stacks, open-ended versus closed-ended funds, and to vertically integrate or not. And we'll leave some time for Q&A at the end. So please ask your questions so we can talk about that at the end. And now to kick it off, John, when people are looking to start a fund and go from where they were to now, what are you seeing in the marketplace of people, what they're doing for investment strategies and thesis?
Yeah, so when a sponsor is moving from what we call the club deal or the programmatic deals, the one-offs, right, to the fund world, really it's about having a focused strategy. So whether that's focused by asset type, by geography, or both, right, being able to go to the market and say this is what you're going to invest in, and this is what you're good at investing in, and why, I think is what investors are looking for effectively. I would say on the contrary, if you were to go to the market and say, we're going to invest in all real estate, because that technically is a specialty within the marketplace, investors would potentially question, okay, well, what real estate, why, where, because, there's obviously intricacies in each of those issues, or I'll say characteristics. And so being able to, again, specialize in a geography or a location or a type, whether that be, core, value add, development deals, different things that, again, you as a sponsor have had experience with, I think is where investors want to be able to trust you with their money and be able to generate a return. And I know we're going to talk about different things along the way that will help build that trust, but as a starting point, I think having that focus is key.
David, what are you seeing in the marketplace? People, or are you advising clients when they want to start out to narrow their focus or to do some all across the board type investing?
Yeah, it's really what John said. You're selling not necessarily an asset, but you're selling yourself. So you want to do something where you're selling where you have experience. So as John said, whether it's geographic, asset class, primary, secondary, tertiary markets, things of that nature. It's very important that you do that. And we've actually seen that not only in the private fund world, but in the public markets as well, where REITs, at times tend to start getting very diverse, and it's much harder for analysts to follow them, and actually drives down their stock price because you don't know what you're buying. So as John said, to me, what's most important is having a focus, something and just sticking with that.
Yeah, no, I agree. What I've been seeing is a lot of my clients that are starting out in the fund source is very, very specific, that they will be either investing in a geographic area or an asset type in a geographic area. Like lately, I've been seeing, some people that are investing multifamily in the Southeast, or I've been seeing that, I'll invest in Los Angeles and New York City, and it could be any type of asset class.
Yeah,
So, go ahead.
Sorry, we have a fund that invests in single family homes in the New Haven, Connecticut area. So, but there's plenty of single family homes to invest in, and people know what they're buying. So it can be as specific as that.
So, and David, just to go a little bit more, so as you're getting ready to go into this fund from what you were previously doing on we'll call it family deals or club deals or programmatic deals, what are the typical setup and legal structure, legal documents that they have to be aware of to get done that may be a little different, than they've done in the past?
Yeah, so the documentation may not be all that different depending on how they did the one-offs. What's different though is what goes into the documentation. So if you're trying to raise capital to buy a 1 Main Street, anywhere USA, you're selling that asset. If you're looking to raise capital to buy office buildings in the Northeast, your private placement memo is going to have more about, it's not going to be specific to an asset, but it's going to talk about that asset class, the risk factors associated with it. I know John will get into track records sometime during our conversation, but you show your track record. You have to talk about your history. So from a documentation standpoint, your private placement memo is probably your most important document. That's your marketing document, right? That's selling yourself, selling what your vision is, talking about what the deal is, talking about what people's rights are, and of course, listing the risk factors to tell everybody that they could lose their money, they could lose their money, and they could lose their money. And then on top of that, we have the operative document, which whether you form it as a limited partnership or limited liability company, which are the two more prevalent ways of doing it, that'll set forth your investors' rights. And then the last, what I'll call main document, is the subscription agreement, where it'll have the investor questionnaire so people can tell you whether they're accredited investors or not, or qualified investors. And again, I'll have a bunch of reps that they're smart people and they understand the risks and things of that nature. Those are the 3 main documents that'll go into it. Setting it up.
And David, I think we spoke the other day about this, is that, depending on where you would put it, if you were doing, more than one area or something like that, would be only disclosure difference would be in the risk section, right? Risk factors, which is the.
Yeah, I mean, that's primarily, the rest of it will be fairly pro forma. When I say pro forma, obviously you're tailoring it to that sponsor, that asset class, but your risk factors will be a little different, whether you're talking about multifamily in the Northeast or you're talking about development deals in the Southeast. There's different risks associated with those things. The other difference will be who you're targeting your capital raise to. If you're looking for a retirement fund, you'll have to have ERISA disclosure. Obviously, you have to have tax disclosure, but if you're looking for foreign investors, there's other issues that foreign investors have versus domestic investors. But the rest of it is pretty much would not be different depending based on class or what have you.
John, what are you seeing like on the audit side, structures, any difference when they, depending on the thesis and strategies that they're doing?
Yeah, I mean, I would say the structures are tax driven, right? I mean, obviously the goal here is to minimize tax, be as tax efficient as possible. And so what we're seeing in the business side of things is structures that really do that, again, in align with the strategy, whether it's a foreign investor or not. Obviously, you need a different tax structure, whether you want to go the REIT route or not, which, we're not going to dive into detail on, but REITs have their own intricacies, and we could talk about that for a very long time. And so ultimately, it's what the goal is, right? Who the investors are going to be, what are the assets going to be, and then aligning the structure to those characteristics. The biggest thing I would say is, as you're drafting these documents, they are very legal heavy, and I think David can attest, but having, your accountant, your tax advisor, your business advisor be in the conversation along the way, to me, provides the most efficient way of doing it, right? I mean, you always want someone looking at it from both of those perspectives and doing it along the way, in theory, right? Versus if you did the legal side first and the accounting side second, will let you go to market faster, right? And so David and I have a client now where at every step of the way, we are looking at it, David's looking at it, and ultimately, once we both stamp it, they're ready to go, right? And so that would be the biggest piece of advice. Again, I think the legal side is always going to drive it, but don't minimize the accountant's view, I would say.
Yeah, and that's crucial, John. Talk about, give a real world example. We're doing a fund. With COVID, I don't remember how many years anything is anymore, but so let's say 4 years ago at this point. And at first it was going to be, all domestic investors. So we drafted a certain way, and you mentioned REITs, right? So, and all of a sudden I said, oh, no, sorry, we're going to raise a bunch of money. In fact, the lion's share of the money is going to come from offshore. So now we want to convert to a REIT structure. Well, that was basically, it was a lot of change. So if we had started that route, so if the client had spoke with their accountants and us at the same time, or actually had the plan in place originally, it could have saved us a lot of time and them a few dollars.
Yeah. So what I see as being the tax person on the panel here is talking about is most of the structuring is to make the structure as tax efficient as possible. I was surprised to hear this, but maybe I wasn't, is that probably the majority of the REITs in the United States are owned by private equity structures. They're very, there's probably, 20 to every one public REIT is in the private structure. So they're doing that for specific reasons, which I'm sure in the webinar series, John and I will go over it further in the future and other ones. But this general and cost, so that's cost, making sure that, we'll get into that a little bit more later, is that the legal documents and the audit, if you have a varied investment of asset or location, does not really matter. It gets to be a fact of your tax structuring and where your investors are coming from, of the cost of operating your fund versus a solo, partnership that owns an asset. Finishing up on this, and John or David, anything more before we go on to the next area?
Go ahead, John. Go ahead.
I would just add with the cost, right? I mean, typically, if you're going on a one-off deal, right, you're going to price out your compliance and your advisory services along with that one deal. With a fund, at least in the real estate space, where we see the pricing move to is a per asset basis, right? And I use the example of $1 billion property, and 5 $100 million properties are going to have different levels of work, right? Even though it's the same amount of capital being deployed effectively. So being able, $100 million assets. So being able to, understand that, right, as you grow your fund and understand that, like, the cost is going to be exponential a little bit with the number of assets versus the capital itself, right? Where if you go to a different private equity shop that's not invested in real estate, that may differ, right? And so we look through the fund structure into the asset side, and I know that's true for tax as well, depending on how many partnerships you have set up underneath, is going to drive the cost of compliance effectively. And so it's just something to think about, and understand what you're getting into as you move from that club deal side to the fund world.
So that kind of leads us to our next topic that I really want us to start discussing, is a little bit about, the optimal target fund size and capital stack, sources of where you're looking for your capital, etc. So John, what have you been seeing and, regarding, target fund size and what people should be looking at? And, it gets to be a little bit of a marketing tool here as well. So.
Yeah, I would say when a sponsor is starting off what we'll call fund one, their first fund, I think as a generalization, I think goals are lofty in terms of being able to raise capital. And again, right, when you're going to market in that first fund, you need to build that trust, right? And so what generally ends up happening, I'll use a simple example. Funds want to raise a $100 million fund. Generally, that first fund ends up being smaller. I'll use 10 million. That's a live client that we have now. They had to get fund one up at 10 million. It's a short fund in life, which we'll talk about later. And then fund two is going to be the $100 million fund. And again, the reason why is that credibility, that trust factor that inevitably you need to build in the marketplace. And you could be having, you could be operating real estate for 30 years in that club deal space, but it's a much different world when someone's going to hand you money and you're going to go deploy it as you see fit, right? Versus a club deal where you're going to underwrite it yourself. The investor's going to underwrite it effectively, or they should, and they're going to make that decision based on the investment. And I think, David, you mentioned it, right? It's you're selling yourself as the sponsor, in the marketplace. And so that's just it's a big change. Again, I think the lofty goals are great because ultimately, you want to be in that space. But you end up inevitably seeing this growth factor of 10 million as an example, 100 million, 200, 500, a billion. It makes sense, right? You're gonna walk before you run. I would say the other question you have to answer with capital stack is, are you going to lever or not, right? So are you going to move to that? Right? You're going to bring in equity, right? Are you going to lever up with debt? And if you think about it, if you have $10 million of equity, in theory, you can go out and get $30 million of debt, and now you have $40 million of asset that you're able to purchase in the marketplace. So things to consider. There's a lot more there, but to me, those are the two biggest as you're considering your capital stack.
David, what are you saying?
Yeah, I guess this is why John and I get along. We tend to agree a lot, but he's right. Look, people have to remember when they do a fund, and I alluded to it earlier, and John just spoke about it. You're selling yourself, and the most important thing, especially with your first fund, is you want it to be a success, and in multiple ways. Not only do you want to generate the returns that you want to generate for your investors, but you don't want to go out and say, hey, we're looking to raise 50 million, 100 million, whatever the number is, and come up short. So it's better to, aim low, or some people say, under promise, over deliver. And you can build an accordion feature into the offering memo where, we're going to do a minimum of X and a maximum of Y, so that people understand that, hey, look, at 10 million, we're going to have a closing, but we're going to do closing until we can get to 50 million or 30 million, or whatever the right number, whatever numbers makes sense for what you're looking to buy. And as John said, if you're going to use leverage, what that grows to. The other factor that goes into fund size is if you're bringing in a large investor, whether it's a private equity fund or just a large family office, they will sometimes put constraints on the amount of capital they want the fund to have, because they want to have a certain percentage of it, which gives them, to the extent there's voting rights within the operative documents, it gives them control or functional control over those voting rights. So some people say, look, we're putting in 20 million. We don't want you to be more than 50 because we want to be 40% of the deal. Things of that nature. So those are the items you look at. And again, and it also comes down to what you're going to buy. If you're buying trophy buildings in primary markets, New York, Chicago, LA, what have you, $10 million fund isn't going to get you one of those. So you have to be realistic in what you're buying and what the capital needs are going to be to buy those things.
Yeah, David. I mean, what I was thinking is that, I've had a couple clients that, you're looking at what size asset are you buying, right? Because
Yeah.
you're buying $1 to $5 million assets, you can absorb a different amount that if you're buying, anything greater to 10. And as you said, if you're going to look at Manhattan,
Yeah.
even today's day and age, it's $30 million to buy a 5-story brownstone.
Right.
But also something to think about is the volume of assets that you're going to hit is you're going to buy and sell, because usually your hurdles based upon the portfolio. So you don't want to have, smaller is better for the fund operator, and they're getting up is to be able to hit their hurdle and gain success going forward.
Yeah, I
So
guess,
that's-
Howard, the other factor, and we'll probably talk about it more when we talk about open-ended versus closed-ended, but is, what's your investment period going to be? If you're going to be closed or open, how long you got to invest? I mean, if you're giving yourself a short window, it's harder to put out a lot of money in a short period of time than a longer period of time, obviously. So,
Exactly. It's going to be the fact is that if you raised $20 million, really, besides buying good assets, which everybody expects, the people that are committing assets to you to invest, they want you to spend that money. So you have to make sure you be able to spend it during the investment period. So
yeah, that's a very good point. So if what people need to remember is when you have a fund, as opposed to a one-off deal, you're not drawing all your money on day one. So if you have a $100 million fund, you may draw 10% on day one because you have a deal in the pipeline and it's going to close. But those people who've committed to invest, let's say somebody's got a 10% interest in that deal, they've funded 1 million, they've allocated $9 more million to that fund. Well, they assume they're going to put that money out. If they don't put that out, within a relative short window of time, that is not going to bode well next time you go to them for fund 2, because they're going to say, hey, look, I committed 10, you only put out, of my 10, 4, and now you want me to put it, you're going to do in a $200 million fund. I have no confidence that you can put 200 million to work, because you're going to put 100 million to work. So all those things go into fund size, but that's why, and John said the same thing on the initial fund. You're better off, they said, under promising and over delivering.
exactly. And then I guess, where are you seeing people raising their money from? I know that, both of you could talk a little bit about how we're using, we see people, friends, family, old investors from the club deals. If you want to take the step up, if you want to raise money, there's actually placement agents out there that will charge you a fee. As I said, I'll put a tax thing into, usually, the fee that you pay them is non-deductible. But if you have smart lawyers and accountants, there are ways to draft the documents to make it a little bit more palatable. So John, if you could talk about that a little bit.
Yeah, I mean, obviously it's all about network, right? And who you know. And I think the club deals and the programmatic deals are going to be your starting point for an investor group. But, generally speaking, when you're moving to that fund space, you need more capital, right? And so there are different ways of going about that. Obviously, placement agents are definitely available to you. Friends and family, it's going to happen. But ultimately, I think it's the network side of things. And then there's programs out there where institutional investors have to allocate certain dollars to emerging funds, right? And so those dollars can't be gobbled up by the big sharks. And so there's definitely an opportunity there to start an institutional relationship or two. There's also now, we're seeing a lot of where institutional investors are allocating certain dollars to a centralized group, and that group is then deploying the capital, right? So almost an intermediary at that point. And so if you get in with that one person, you then have visibility into different institutional investors. So definitely different ways of approaching it. Again, I think it's ultimately who you know is going to be your starting point. But I think the goal, right, if you're trying to grow your funds and grow the size of your funds, is ultimately getting to that institutional world. And again, they're going to want to see a proven past, right? And that's where we start talking about track record reporting and being able to, go out to market and show these investors, potential investors, a proven track record that is either on the club deal space, on the fund space, or both, is really advantageous. And we here at Mazars and others as well, we verify these track records. And I think it's an important component. To say a third party, it's kind of like an audit, but we don't use that terminology, has quote unquote audited my track record and put a stamp on it. And, we even for an investor or a sponsor put together what a fund would look like if all of their club deals fell within a fund, right? And it was an interesting exercise for them, but again, it showed potential investors what that could look like. And they can go to, on top of the PPM, which David mentioned is your marketing tool. This is a nice, clean, crisp report that you can go on top and add alongside of it. That's easy to read. It's going to incorporate what the key KPIs are. And I think investors are very receptive to reading that.
David, besides everything that you agree that John said, anything else you can add?
Yeah, so just two little things. So if you think about a shopping center, right? Shopping centers like to have an anchor tenant, right? That draws. That's why they all love grocery stores. Good groceries, right? Because the grocery stores throw off business to all the other spots. So the smaller mom and pop folks want to be in shopping centers with a strong supermarket, right? It's not that much different in funds to a certain extent. If you can get a couple large investors who have some cachet to them, it's easier to sell to the smaller investors. It's a lot of work. If you're start, it's what, $10 million. Not that that's not a lot of money, is a big difference than $100 million or $500 million. You need big investors for that, or you're going to be really beating the bushes, and turning over every seat cushion to try to find all the nickels and quarters you could find. So that's where I think placement agents come in handy. To the extent if you don't have entrees into the private equity, large family offices, those types of investors that they will help. Yeah, it's going to cost you a few bucks, but in the long run, it'll make you a lot of money. So that's the one thing I would add on the capital raise. John mentioned, and I know we've mentioned a few times, and I guess this is probably as good a time as any to really talk about it, is the track record. I can't stress enough how important that is. We said before that when you have a fund, you're selling yourself. You're not selling the property. And to not show somebody, say, hey, look, I've done these 40 deals over the last 5 years in this geographic area or this asset class, or maybe it's multiple asset classes, and here's what my track record looks like. Not to have something like that it's going to be very hard to raise money, because that's what sells you. We can be the best sweet talkers in the world, but at the end of the day, the people who are going to invest money, other than maybe your friends, family, and dumb people, is going to be based on what your track record is. So, and when you do a track record, as John will tell you, you can't just say, well, I'm going to pick these 6 good ones, I'm going to leave these 2 bad ones out. 1, because you can't do it. 2, because you can't do it. And 3, because if you do it, you'll get sued when things go bad. So, and again, somebody who looks at it knows not everybody always hits a home run. And frankly, not everybody hits a single. Sometimes you strike out. Anybody who constantly has a year over year, great return, or every deal works good, usually ends up in jail because it's probably a Ponzi scheme. So it's important.
Yeah, exactly. I guess, what we're trying to summarize here, but we'll go from here, is like, name awareness is important when you're doing a fund. As I said, you're selling that, before it's when it's asset by asset, if the asset stands on alone. Right now, when you're doing a fund, you don't have any assets. The asset is you, yourself, and your team around you. So John, can you talk a little bit about, obviously, we've been talking about the track record, but, we've seen people give, some testimonials from existing investors, et cetera. So.
Yeah, definitely. I think David hit on the point where if you have a large investor or two, right, getting a testimonial from a name in the market that carries some weight, obviously is going to help for any new investor you're trying to get on board, right? Or even setting up a call where you can talk about their relationship and why they have chosen to invest with you as a sponsor, why someone else should, right? And it's a lot of marketing and selling. Ultimately, it's what you're doing, and backing it up with results. I mean, obviously we'll talk about fees a little bit in this webinar, and I know in the next one, but there are ways to make sure the sponsor has skin in the game and they're incentivized. But demonstrating what you're capable of doing in the market is step one. Getting others to back that up, I think, is step two, right? And so you don't want, that's also making sure you choose the right investor who's willing to back you up, right? And different ways of doing it. I think ultimately having a testimonial, having a track record, and just demonstrating a good history are the three best. And then being realistic with goals of fund size and even the fund return, right? Ultimately an investor is going to want to have a guess, right? In the PPM or other offering memorandum, what should I expect to receive back, a return on my investment? Make sure that that's realistic, right? Don't promise a 25% IRR and realistically it's going to be a 15, right? And so being smart about that. Maybe, I know under promise, over deliver. Obviously, there's a kind of a minimum you kind of have to hit to entice the investor. So I would say try to get that as clean as possible. But I think investors these days are pretty smart. A lot of information out there in the world, and it's easy to kind of see through, smoke and mirrors at times.
Exactly. It's as we said, putting everything together here is the story you're telling. Doing an asset by asset deal is the asset itself. Now the story you're telling is a combination of many different factors which have to be put together. So as we were talking about before, talking about, assets, geography, the less specific you are, the more difficult the story is to tell, right? So that's just, think about that. And that's where you have to think about it. John, David, anything else you want to hit up on fund size or capital stack, to talk about that we've missed that before we go on to the next topic?
I think the only thing I would add that probably is in the first two topics we talked about that would be beneficial for those trying to thinking about doing a fund is, keep good records. The better the records you have, that when you sit down with your attorney, your accountant, your professionals, what have you, the more efficient the documentation process will be. Whereas if you just walk in and, and we'll go back again to track record, but if you don't have the information to do one, it's going to be a problem. So, start today. Don't wait until 3 years from now when you say, okay, I've done my 20 one-off deals. Now I want to do a fund. And then you go back and you're like, oh, I got to recreate, figure out when money came in, when distributions went out, what my return was. And, you hand John or you, Howard, a shoebox full of bank statements or something. It's going to take longer and cost more money.
John and I will both tell you we've been there before.
Yeah.
I mean, maybe it's an electronic shoebox these days, but yeah.
All right, I'm aging myself a little. Okay.
I was going to say I've seen the shoebox, so that's just what it's going to be. So
I would just say to that point, right? There's never a bad time to start creating a track record. I think starting at an earlier time, then you can make little updates to it, become a little bit easier and palatable on the cost, right? Yeah, you're going to spend a little bit more over a period of time, but you're doing it along the way. And honestly, even for club deals, right? It's always nice to say, here are my 10 clubs deals. They've been verified by a third party, and here's the 11th club deal. Come invest in me with new money. So never a bad time. But I would agree with David for everyone's sanity. The cleaner they are, the faster and more efficient everything is.
Oh, okay. So let's start going to the type of funds. Open-ended versus close-ended. John, let's just start with, because not everybody might not know the difference. So we'll start with what the difference between an open-ended and close-ended is, and then we'll go from there a little bit.
Sure. So an open-ended fund is, as it sounds, perpetual, right? As a starting point. It's not indefinite, right? A lot of times there is a life to it, but investments can be made throughout the life of the open-ended fund. Meaning you can go out and buy an asset, you can obviously sell an asset, and then generally you can bring in investors and remove investors via bringing in new investors, right? So that's an open-ended fund. On the inverse, right, a closed-ended fund has a finite life. It has an investment period, and we'll use a standard 10-year life of an closed-ended fund. Apologies. There's a 3-year life where you're going to buy assets and raise capital, and then a 7-year life where you're going to hold and sell. depending on the market, right? And there are mechanisms to extend or shorten those, that 10 years, but effectively that's a general, general closed-ended fund. Typically what we see, right? Closed-ended are easier to deal with, easier to operate. Open-ended funds tend to be a little bit more cumbersome, a lot more reporting, and a lot more, I'll say, compliance as it relates to bringing in and getting rid of investors. And so generally we see the closed-ended fund, especially on the emerging fund size, but, with maybe the goal of moving to an open-ended fund as, potentially time progresses.
David, anything that you're seeing on the business side or the legal side on, difference between open-ended and closed-ended?
Yeah, I mean, it's what John said. Open-ended funds are far more cumbersome from a operational standpoint because you're going to have people coming and going. There's some more regulatory issues you've got to deal with in those situations. I would think that somebody who's just doing their first fund or two would focus more on a closed-end fund. I see, open-end funds tend to be a lot more of the private equity firms that are doing very large funds, so that it creates liquidity for people who may need it going forward. The other issue that an open-end fund has is because they'll have redemption rights, whether they're quarterly, semi-annually, annually. You need to keep your dry powder available to redeem. Obviously, there'll be a cap on what will get redeemed and a time period in which it can be redeemed out over, but you have to keep capital constantly flowing to deal with that. Whereas in a closed-end fund, you draw capital as you're buying assets. Typically in a closed-end fund, as John said, you'll probably have a 3-year investment period. It may not take that long, which will have a 3-year investment period. And a lot of closed-end funds will allow any capital that's been deployed within that 3-year period, and then you sell that asset, or if you're doing, if you're basically making your mortgage or mezz loan fund that's lending money, those loans get paid back. You can reinvest that as long as it's within the investment period. So they're a little easier to manage. They're a little easier. I'm probably more little than a lot. They're a lot easier to manage. I think a lot easier to market to the marketplace. They're easier understood. So yeah, I would recommend to anybody who's just starting out that stick with a closed-end fund.
Yeah, I mean, one thing that I think is important for, maybe we can get into a little bit, is that, obviously there's valuations are important, right? And the differences that could be is obviously open-ended would need, if you had quarterly redemptions, you'd need valuations on a quarterly basis, which actually means stuff because people are being liquidated on a quarterly basis, versus a close-end where, they may have valuations done on a quarterly basis for their investors to see where everything's standing, because certain investors require fair value on a quarterly basis, and then the end of the year there's an audit on a valuation. So John, maybe you could discuss a little bit that, because you deal a little bit more than the valuation side than I do, at least on tax.
Yeah, I would say the benefit, or not the benefit, but for an investor perspective, I think investors expect fair value, right? So that is a big change that, from what I see from club deals, where it may require it, but it may not. Generally speaking, the private equity funds require it because investors want to know what it's worth, right? I mean, if you think about buying a stock, you can look up your stock ticker and know what your value is worth at any given point in time. I think to Howard and David's point, it's more done on a quarterly basis. We do predominantly see both closed-ended and open-ended have a quarterly valuation. It's just that I would say on an open-ended fund, it's a little bit more scrutinized because of that capital coming in and out. And so, getting that valuation done, is a task. There's different ways to do that. What we see typically is, a third-party specialist is engaged somewhere along the way at different points in time, not every quarter, not every year, not for every asset, but getting an appraisal of some kind done is a key factor to that valuation. Again, I think investors expect it, especially as you move to the institutional. They definitely expect a valuation done. So something to keep in mind as you're starting your fund, and making sure you have expertise in-house to produce those valuations as well, or review them if they're done by a third party. is a key factor here, right? I mean, it's something that's required. I'll quote the codification once, I promise, as an accountant, it's ASC 820. So if you want some light reading at night to fall asleep to, that's a good one. And there's also the investment company guide, right? So different things to take a look at. But if you think about it, right, what is my investment worth? The only way you can really do that is to report your real estate at the minimum at fair value, and potentially even your debt at fair value, depending on your goals and what you're trying to accomplish.
Yeah, John. So this one thing I wanted to throw out, because that I just thought about now, is that, regarding the valuations. So there, and David, maybe you can say if it's written in the documents or not. Like, so the valuations are generally done internally, but funds, at least closed-ended funds, I think I have seen, a certain external valuation or a certain percentage of the portfolio over a certain period of time. So John and David, if, is that required, John, under any rules or the best practices? And David, I think that I've seen it written in some legal documents that they go through.
So required, no, by rule. However, best practice is to have a third party look at each asset. A common number that we see is on the 3rd anniversary or on the 2nd anniversary of an asset being purchased, it gets looked at by a third party. Some funds go as far as they do one full appraisal every year, and then what's called a desktop appraisal or a mini appraisal every quarter. I mean, that's, to me, a little bit on the higher end of frequency, but it is done in the practice. But I would say at the minimum, some systematic approach to evaluation is a best practice, just because there's so much scrutiny. The three of us can look at an asset, and I promise you we won't come up with the same. We'll write on a piece of paper, it will not be the same value. And so having that done, by a third party, it will add some value in the marketplace.
Yeah, so from a documentation standpoint, I know in a few fund deals, both where I've represented the sponsor and then represented a larger investor, private equity fund that's investing. The private equity funds a lot of times will require that a independent accounting firm such as yourselves, Mazars, will do fair value accounting on an annual basis, because they need those amounts, because they're compensated. The private equity firms are compensated based on assets under management, right? AUM. So they want to know that, hey, we put in $20 million into this fund. Their assets are now, our $20 million now, our 20 million investment is now worth 30 million. Well, that's money in their pocket, and that's important to them. So they'll require that a firm like Mazars will do a fair value accounting each year, as opposed to just being internal. Because the sponsor doesn't really, I don't see very often where the sponsor is compensated based on value for the exact reasons you mentioned. So arbitrary, unless you have unless you have a liquid asset that you're investing in. So you're investing in securities or things of that nature. But yeah, so that will be in the documents.
Yeah, one other subject that fits kind of in this basket here is when we have closed-end funds, and we're talking about having commitments and the fund starting, is usually you have a couple of close dates. Usually you say we're going to raise $25 million and we will do our first close when we have 10, 12, whatever it's going to be. And then, not that we're going to talk about fees here, but there are ways to incentivize people to invest in the first close by giving them fee breaks. We'll get that more in our next webinar, but there are ways to account for that, John. We do, tax, there's legal ways to draft it, et cetera, that's in the agreement. So if we can talk about that a little bit.
Yeah, I mean, there's really two ways. And just to reiterate what Howard's talking about is, if you have a $25 million fund, in close one, you have $10 million worth of investors coming in the deal, and then 6 months later, you raise the remaining 15, what happens with that 6 months of time, right? And so there's, again, two popular ways of doing it. One is the revaluation, where at that 6 month period in my example, you would go out, get a valuation, and then that equity, whatever that percentage they're trying to buy, is worth, X% of the fair value of that fund. The other is the rebalance, where investors come in at 6 months and they're charged effectively an interest, right, to pay the old investors for the period that they were there for the first 6 months. What I will tell you is the rebalance is the more popular because there's zero scrutiny on rebalance, right? It's purely a math equation. It's written in the agreements, and that's the way it is. Versus the valuation where you have to apply some kind of scrutiny on it. And again, because the three of us come up with a value, a different value, it's one that's shied away from just because you don't want to get into an argument about the value from any investor. And so that's typically what we see, is that rebalance. It's math, it's some complicated math, but again, no scrutiny at all, just making sure the numbers make sense.
Yeah, I just want to take one step back. We were talking a lot about closings, investment periods, life of a closed-end fund. Make sure everybody understands what we're talking about. I imagine you do, but just in case. So typically what will happen is you'll start the fund, you'll say, we're going to have our first closing once we have, to use Howard's example from before, at $10 million. And then we'll have an investment period. And let's say it's a 6-month window that we can bring in capital. So we'll go up to 25, but we'll close, our first close will be at 10, and maybe we'll have subsequent closings every 5 million or what have you after that. So now, and when we say those are commitments, that's not actual cash, right? So somebody fills out their subscription agreement, like we talked about earlier, and they commit to $1 million, you draw 10% on, at the initial close, they put in 100 grand and they've got a $900,000 continuing commitment. Then we'll have an investment period called 3 years, that over that 3-year window, the sponsor can call capital for deals, to pay fees to the extent needed or operating expenses. And that can be done over a 3-year period. Again, a lot of funds will say if we sell an asset within that period, we can reinvest that period. Then you'll have a 7-year window in which to operate, manage, sell the property or the properties or the assets. And then a lot of times, because you don't want to be stuck in a fire sale situation in a down market, you'll have the ability to extend for another year or two after that. So that's just so people are clear, that's the general structure of the timing within funds.
Yeah, exactly. So what I was thinking about is also that, as John said, when you come into subsequent closings for financial statement purposes, it's assumed that you're coming in from the beginning, right? But just remember, for tax purposes, you're not a partner till you're a partner. So there's actual sales transaction, going between the partners going on for that. And it's just a little bit more complicated to go from there. But now, just to push to another topic is discuss, should you be vertically integrated or not? So John, maybe you can talk about a little bit what we mean by that,
Sure.
and we talk about that.
Yeah, so I mean, the term vertically integrated, at least as we're defining it here, and we see in the market, right, is when if you're going to buy the real estate as a sponsor via a fund, you're also going to operate the real estate as well. So you'll have boots on the ground. Well, you'll operate the asset. That asset will roll to a fund where you have investors come in, and obviously you're managing the asset there, and then you're managing the investors from the investor relations side. So it's a popular model, and the biggest reason why, honestly, is control and fees, right? So you're going to have fees along the way. Again, we're going to talk about that more in our next webinar, but different ways to structure those fees and kind of maximize your dollar out, but you're putting a lot of the work in. Versus if you were to not vertically integrate, you would hire either a property management company to manage the asset for you, or you may even get a joint venture partner, right? Where we see it commonly is if you're going to buy, if you're a New York-based fund, just to use New York since we're all sitting here, the concept would be that you would go out and get a joint venture partner in a local market that you're investing in, because A, they have the expertise and they already have the boots on the ground, right, in that locale. And so you're not managing people from a different area. They also have skin in the game, and they're able to have that expertise in that local market. So definitely a different approach. I'm not going to say one is better or not. I think it's more what you're trying to accomplish and what risk you're willing to take on, and what you have the appetite for, and really where your focus is. I think clearly doing it the latter, way is going to allow you more time to focus on the investments and the investors, versus the former, where you have to make sure your focus really is more on the asset, or just equally on the asset, I would say, as the investors.
David, any thoughts from your side?
Yeah. So as John said, especially if it's, like development deals are a big thing. If you're not a developer, you're going to need a local developer, but it's not just, think about what does it take to not only deal with the property, but deal with the fund itself, right? So you've got your property management, the property, you've got asset management. If it's a development deal, it's got to be developed, right? So you've got, as John said, you got boots on the ground locally, but you also have your fund issues, right? You have investor relations, right? You've got investors. I mean, they like to hear from you every now and then. You need people you need internal accounting, you need legal help. So if you have the infrastructure that can do that, that's great. If you don't, that's where, you guys, Mazars comes into play, we can come into play, Mulch Living come into play and helping out. And those are all things that depends on the sponsor themselves and what they've established. And it may be that they start being non-vertically integrated, and ultimately as their asset base builds up, where it makes sense to have employees and have your property management wing that can manage your property class, to have an internal accounting department, because it gets costly to have an accounting firm do all your property level financials. If you have leverage, right, you're going to have to do reporting to your lenders. So you constantly want to go to your outside accountant, or do you have the in-house staff? So again, I don't think I think about with a lot of things we've talked about today, it's not a one size fits all. It's what your goal is and how big you want your organization to be. I mean, it's certainly always nice to keep fees internally because it's another revenue source, assuming you're not spending more in that area. But if you're going to have a property in one property in 10 different locations, property management is not going to be good for you, because you're going to need regional people in all those areas. Whereas if you're centralized, you can have one localized office where you have one regional manager who can oversee all 10 properties. So those are all things that develop over time.
Yeah, I mean, as some wise client said to me once, managing property, property doesn't talk back. When you're starting to manage people, they all talk back, right? So think about that as, and it takes a certain amount of fixed costs to do all this. So you really have to analyze your revenue streams from all these areas to see, maybe not the first fund, you have to do that. I mean, John and I have a client right now that has just started up, so they are outsourcing, we'll call it the back office a little bit to us, and really fund administration and stuff for us to do. And we're able to do that because, as he said, as I get my second and third, we'll call it fund or properties outstanding, and the fees start growing a little bit, he's willing to hire the necessary people to do that, right? So don't lose your business acumen, to get stuck on all this stuff. And as David said, hopefully it's a revenue income stream, not a loss to you.
Right. And we do the same thing, Howard, where when folks are just getting started, we'll do every daily type legal thing that comes about. When you grow to a size that you need in-house counsel, you should hire in-house counsel.
Right.
Yeah, I would agree with that. I mean, I think being able to, the other side of the vertically integrated, and it's been a common practice, I would say, or a more popular practice in the last 5-10 years, especially in the last 2, is outsourcing some of the accounting and back office function, right? So it's not just accounting, though. It is the investor relations side, and being able to, avoid the pitfalls of the great resignation, as it's been dubbed, right? And having the human capital error issue be solved for you by making it not your problem. I think there's value to that. And also the expertise in the market, right? I mean, the market's changed even in the past 2 years, obviously. And, having someone, independently hearing their ear to the ground and hearing different things and being able to give you that information back, that has value as well.
Yeah, and just, I know we're not going to talk about fees, but there are ways where you can vertically integrate without vertically integrating, and you're not necessarily getting all the fee, but you keep a little scrape of the fee and let somebody else do the work. So there's lots of different tricks to the trade, as you guys said earlier. So
Yes. So we're getting close on time. Is there any questions out there? I think, John, you said you had one you saw.
Yeah, there's one question that came across. So please, if you have any questions, put them in the Q&A. One that came up that is a popular one, I would say, is, how do you go about time-wise moving from fund 1 to fund 2 or fund 3, right? And the reason why you have that investment period, especially in a closed-ended fund, is so that once it's closed or about to close, right, you can start, depending on what your documents say, start raising the second fund and move forward with that, right? And if you think about it, if you didn't have that mechanism and you had 2 funds live at the same time and an investment came in, that you'd be conflicted into which fund it would go to, right? And generally, as a sponsor, you're in a large area of control. And so what we typically see is funds operate multiple funds at the same time, but never really in the same acquisition period as the other. And so it's exactly for that reason. It's a very, very popular issue that everyone's eager to kind of start that second fund. And again, the legal docs, and I'll let David speak to that, maybe have a mechanism that can give you the ability to close the acquisition period earlier. But generally speaking, you have them not buying at the same time.
yeah, John, and documents will provide for, as fund 1's winding down and fund 2's up and is getting up and running in allocation, to the extent you need to do an allocation, because you want to make sure there's not a gap. So it'll address that as well. Agreed. And I guess the one thing I just wanted to point out as well is, the larger the fund gets, the more securities law issues you start thinking about. When I say securities law, it's not necessarily a 33 and 34 Act, which people know about, but there's an Investment Company Act of 1940, Investment Advisors Act of 1940, which I will not profess to know all that much about. That's a very highly specialized area, but the larger you get, the more that comes into play, and those are conversations that need to be had. And there's also a blue sky, which is what people call the state. All the states have securities law issues. So again, they're not big issues when you're smaller. They get a little bigger when they become a bigger issue when you come a little larger. Again, things that we can navigate, no problem. It's just things to be, when you're thinking what you're doing and cost effectiveness and that, you have to take into account.
All right, great. Let's just wrap up here. I want to thank you, David. I want to thank you, John. I want to thank all the attendees for attending. And I just want you all to be aware that our next webinar is going to be based upon the fee structures that are there, which I think that'll be a very key topic, and most people are interested in the fee side of it. Believe it or not, I believe the private equity business has become a fee-based business, which is pretty interesting. So it's like, probably 100 different type of fees that I've seen, given across the board here. So again, I want to thank everybody. Everybody have a great day, and look to see you on the next webinar.
Thank you, guys.
Thank you. Okay.